Okay, good afternoon, gentlemen. My name is Kozomba. I hope everyone can hear me.
Yeah.
My name is Kozomba. Just give you a little bit background of myself. I did accounting at the Polytechnic in 2018. Now I'm working with the automotive products. Most now is commonly known as Isuzu Malawi. I'm in finance department and mainly I'm dealing with the reports, the financial reports, reducing accounts, dealing with all the issues like. So I've been tasked today, this afternoon, with presenting you on good accounting practices SMEs in the agro-dealer sector.
Yeah.
First of
Okay.
if we are quite familiar with the accounting, I don't know, take it from the basic start or should we go straight forward?
Bwana Nelson. Yeah, he was asked amafusa kuti ayankhuza accounting kuyambira ma basics kapena really straight to the point.
What's your plan?
Okay,
Okay.
zimatengera.
In my presentation, I was assuming that you are not completely familiar with the accounting, so I wanted to take it from the start.
I think just take it from the start.
Okay. All right, thanks. Now, first of all, when we are talking of accounting, we are talking of a process of recording financial transaction pertaining to a business. So you have in that recording you have documents, for example, what you are buying, what you are selling, what you are expensing. You have bills, electricity in that business. So you have, when you pay all those transactions, you have to record them. You have to record those transactions. So it's a process. In that process, you summarize everything what you have transacted during. Sorry?
Yeah.
Okay. Now, then you once you have summarized, you analyze that data, then you make a report. That report is important not only to yourself but also to people who are interested. For example, like MRA is also interested, may be interested. Regulators such as the reserve banks, general banks, or other investors that want to invest in your business. Now, in order to achieve that process in accounting, you start from step by step in every transaction. Okay, now, one, a good accounting procedure should have a clean and thorough record. Now, in order to do that, there are books of accounting that they are primary. The basic start from where you start from recording your accounting. So, for example, you have purchase. Whatever you buy, you have to record the receipts. So that, for example, if MRA wants to verify what you are claiming on your VAT, you have to support that with that evidence. And if you wanted to claim that VAT on what you have purchased, you have to register with VAT. So just take into account that. And also, there is a sales book. You have to have a sales book account. Same as purchase, you have to store it, or what you have sold in that period. Then there is one cash book or bank. Whatever you have sold, it is recommended that you bank rather than keeping them cash. So you have transactions from what you have bought, that is purchased, what you have sold, and whatever money you have goes to the bank. So these are the three books.
Before you continue. Hello? Hello? Can you hear me?
Yes.
Oh, I meant Bwana Kazomba. Can you hear
Yes,
me?
I can. Yes.
Oh, I was saying that I'm not able to see your presentation.
Oh.
Yeah. So can you try maybe to share?
Okay.
Yeah.
Assuming that you are seeing.
So what you're gonna do? I think stop sharing and then share again. But then just share the presentation. Yeah.
Yeah. Can you see? Okay.
Oh yeah. Now I can see. Yeah.
Okay. Sorry, apologies. Okay. Now, as I was saying, the primary books of accounting, every transaction taking place in a business, it has to be recorded in the books of purchases, in the books of sales, the money have collected in the cash book or bank, and the last one, the fourth one, expense. Expense. This includes the utilities, salaries, allowance, any other expenses that you incur that is not directly related with the goods. We call them expenses. So these four are just the main one that take place. But there are some which also take place, and they are not really critical. But the main critical ones, these are the four main boxes. Once you maintain these four main boxes, then you are able and you are good to produce your report. Because if auditor comes, you will extract information from this box, and it is very easy to produce the report if you have all these boxes. Now, the second element that you need to keep in mind is if your personal and business financials are completely separate. This is very important. Business transactions must not go together with the personal transaction. You have to keep them separate. It is recommendable to open a separate bank account from your business and your personal account. Ensure that the employees are not buying things for personal use with the business funds. Business. No, this is my when it comes to tracing, when you're doing audit or MRA, verify your account. it becomes difficult and suspicious. Why are you transacting your personal funds and business? So we have to keep them separate. Any money that you are putting into the business must be accounted for. Wanenga ndama zako kuweka business, or that is already running, you have to make sure that you have accounted for. But is it a loan to the business, or is it you are injecting more capital? So if you are not, if that money is not counted properly, income or equity of the business must achieve from nowhere. So you wonder the drama you show kila. And if in drama that you look at business from nowhere, you'll be taxed from that money. And if you don't remember what in drama, now you don't that is it. Sorry. Sorry.
Yeah, Bwana Nelson. Hello.
Hello. Hello.
You are saying something?
No, let me.
Okay. Okay. The third thing, what you have to understand when you come to accounting is you need to establish internal controls. When you are talking of internal controls, we are referring to rules, policies, procedures that you adopt to ensure correctness of financial and accounting so that you are protecting the business assets, there's accountability, you are preventing errors, and you're also preventing fraud. So internal controls, you are looking like whatever you buy, is there supporting document that can support what you have bought? Receipts, they are part of the internal controls. No. So that means something wrong with the how sure are you with the stay in line with the what money was given to that person? Segregation of duties. Segregation of duties is also one of the internal examples of the internal controls in a business. You look at someone, for example, who is receiving money may not be the same person who is also doing, for example, bank reconciliation. You have to make them separate so that no control drama business. Otherwise, atobanga manipulating and ubanda access to rights and the rules to critical financial information. As my files a company, a business, you need to also put those files. When I say samangona, physical controls. Physical control for having safe or drama where you can keep your money. These are as part of internal controls. The reconciliations among the deposit money with bank. You have to sit down at the end of the month, produce a bank statement, and reconcile the mabukano. What you have deposited is the same with what is in your books. Otherwise, if there is a difference, then you have to find out where is the difference coming from. Same way as stock take. Stock take is also part of internal control. Stock take, verifying physical stock at the end of a certain period, whether quarterly or half a year or at the end of the year. But it's recommendable maybe to do it for quarterly stock take so that you are not surprised. When you're doing stock taking, but it becomes very difficult to trace what is stock and but regular stock take is very important to ensure that the stock is properly secured. The fourth element, what we are looking at is you need to evaluate your financial data monthly. At the end of every month, you should be able to build the monthly report package. You have which report out what business and a bunch minimum. And business that report it is advisable you should compare with the budget. The budget, are you going off course or you are in the right track? In that way, it ensures that you are in the right track and you're not maybe expending too much on the unnecessary expenses. And if you are making a lot of sales, it also helps you to analyze where are you making that kind of sales from. Because in your budget, you budget such kind of revenue. So it helps you to give you insight of what is happening. Another point is plan your taxes. This is very critical.
What's another issue?
Sorry?
Yeah, like I'm unable to see one frame of your presentation. I'm not able to see the other ones.
One frame.
One frame, yeah. Keep clean. Then yeah. Keep clean and thorough records. That's the only frame I'm able to see. All right, yeah. Oh.
Okay. So I don't know. Do I go back or should I continue?
I think you can continue.
Continue. Okay.
Yeah.
Apologies because I noticed. I think it's because I full screen. Okay. Yeah. Okay. Another point is you plan your taxes. Planning taxes is very important. And how am I going to taken by surprise? With 14/1, they have to pay withholding, have to pay PYE, but they don't have money. So they're stuck. Agabwereka at maintenance or adding a good in Dharma. Whenever delay pay the charge penalties by MRIM. So in every business, we need planning taxes. The good thing in the MRI gave us a good period where you can plan properly. For example, PYE on 14th, withholding on 14th, VAT 25th, FT 14 on every quarter. Provisional tax. Most people forget about provisional tax. Provisional tax, at the end of the year, a business is supposed to declare income tax. However, if during the period, if the business sees its profit, they will make a profit in that year. They can calculate in per quarter how much they expected to, how much they're expecting would at the end of the year they were going to pay tax. So after 4 months, they can calculate, okay, let us pay MRA, let's say like 50,000. 50,000. Now 50,000 is imakanga advance income tax. After support, you calculate how much you are expecting you can pay. Now, when it comes to the at the end of year, when you calculate your income tax, provisional tax. So provisional tax is important because one you pay in advance and similar car burden at the end of the year. Also, it is a requirement by MRIA. Now, income tax is the one that you have to pay at the end of your business. Okay, is accounting software. It is important that you have a business have accounting software. I know they're expensive, but we can, for low budget, we can use, for example, Excel. You can also be able to use as accounting software with the right formulas and indication. This helps you. This helps reduce burden when producing, and also provide a good way and serve your information. File so this information you can save it in the cloud, so it's good. And when it comes to also auditing, it's very easy to audit when you have everything in Excel or in a software. And the 8th point is consult with the experts. Accounting forward, but I'm not sure. Mainly, for example, mainly for us who are not familiar with accounting, when you are not sure, you have to consult and talk with the auditors or accountants or even MRIA. MRIA, they are very friendly. When there are issues you want to ask them, they can assist you. Don't charge for that. So you have to ask them, you have to talk with them. Otherwise, you end up being charged with no penalty. That's cool. So all they are helping us to build our accounting reports. If tikazita nazosezi kuzika pamoja, in the end muona kuti yani will be able to produce three main reports that are essential for our business. Okay, before into the 3 main reports, there are questions, there are comments. Okay.
No question right now.
Okay. Now, as I was saying, financial reports, they're broken into three main. Because I'm at 4 and I'm at 5, but the main one, there are 3. Income statement, sometimes also referred to as statement of profit and loss. Then there's the balance sheets, sometimes also referred to as statement of financial position. And there's cash flow. The other common report statement changes in equity. Some put it separately, but some also put it in under balance sheets. Okay, now let's look at them individually. Okay. Now, income statement or statement of profit and loss. This is the income statement that focuses on revenue, expenses, gains, and losses of a company during a particular period. So my sales, my purchases, my expenses, my utilities, my wages, my entertainment, my employee wages. Those they all come together under this report income statement. This is what it shows you what in that year how much is profit, how much is your tax declaration, and the MRI focuses mainly in this section. Because in this this is where from your tax is going to be calculated from. So MRI mainly amangana this kind of report. So an example minimum of income statement at the very top we have revenue, sales. If there are other revenue, for example, my interest, or maybe you deal with the other big different kind of business. Example, the exchange gain. These are also kind of other revenue to your business. They are not your main business. They are not the main business. They're just part of other revenue that you have generated in that period. Then you have my cost of goods sold. My cost of goods sold, you're talking of what you purchased. Minimum police money that you used to acquire those goods and the cost of goods sold. And then there's expenses. For example, you are looking at the accounting, and a consultant. You employed let's say an accountant, a consultant. So you're paying that person. You go under accounting, you have advertising, budget, depreciation, insurance, rent, software, telephone, utilities. All those goes under expenses. So then you have net income before tax or net profit before tax. So from the revenue, you have to your select cost of goods sold. You have also to your select my expenses. Then you have my net profit or net income before tax. There, your sense. There, you have to post your select any bit of MI. Arrive at net income. Okay, now let's look at balance sheet. Balance sheet explains the financial position of a company at a specific point in time. So balance sheet is continuous, unlike the income statement. Income statement is within a year. It was many business year and data during that year. But the balance sheet is continuous. So that's from what the many Nambila business up to that up to now. Number 2020. So accumulative. So it talks of what and how healthy is your business, and often is used by parties. For example, like banks, my lender, my investors, they want to see how healthy is your business. The business it focus on this section of balance sheet. So balance sheet looks like this. So you have at the top you have my assets. At the top we have my assets, so they're categorized like current assets. Then you have my long-term assets, also referred to as fixed assets. So my current assets, as in for example, you're looking at the cash, and you're looking at the accounts receivables. My customers are many sana who repeating. You're looking at the prepaid rent. You're looking at inventory, that is stock. Those are examples of your current assets. Then you are looking at long-term assets. Long-term assets, for example, makula business annual, makula building. Those are your long-term assets. And so you are going to use them for a very long time in your business, 2 to 3 years, 2 to 3 years. Unlike which in current assets, so you are going to use it in that period, in that accounting period. Then you have assets, then you add them together to current total assets. So you have current assets plus long-term assets come up to total assets. Simple, then you have my liabilities. Always so your liabilities is just like a assets is made up of current liabilities and the long-term liabilities. So current liabilities, for example, you're looking at account payables, anthu okuti akula pambongole mufuna mwalipire. Looking at the accrued expenses, ngati ma taxes, okuti chaka chatha kumulipira next year, zoti mulipirapi. So there are accrued expenses and earned revenue. And earned revenue, for example, you're looking at the muntu wahu asani deposit kuti mumpangire supply katundu. Mumpangire supply. So ndama imeneyo it's not your income, it's not your revenue here. If you fail to deliver, you have to give that person back that money. So you have to recognize that money as a liability. When you deliver service to your part, so you recognize it as a liability and a talent. And the long-term liabilities, sometimes you matter of a loan, like you pay in 3 years. So 2 years, yeah, 3 years, maybe long term, because you're not going to pay that in that accounting period. You're going to pay it so low. You may provide for provisions. We are expected to incur certain expenses. For example, let's say like my warranty. If in the business channel also you provide which in my warranty. So warranty can be in 3 years, 2 years. So you have to recognize within the liability. Claim, you have to pay for that. So recognize warranty in that you could have charged long-term liability. So current, just like a fixed assets, current liabilities and the long-term liabilities come up with total liability. Then there is owner's equity, that is the capital many one guy inject into the business. So business minimum one inject, for example, shares and 10,000. That becomes your owner's equity. But you find that you matter grow jagajata mabanga profit. Now that profit you don't want to consume it. You want to put it back into business. Names are loan that retain earnings into business, and it becomes also part of your equity. Also, you have reinvested back in mabanga profit in that year. Soon as you know, have invested back. So balance sheet normally, balance sheet. When you add the equity plus the liability, when that figure is equal to your asset, that's why this thing is called balance sheet. It has to balance. So when you're preparing this section, balance sheet, it always has to balance it. So a simple formula, the asset is equal to liability plus the equity or capital. The many above, or many assets is equal to capital. Capital plus liability. Now, the last part of financial report is cash flow. So cash flow, the statement that summarizes movement of cash and the cash equivalent that come in and go out. So Pamakala activities during that period that help making movement, that helping in movement of the business. So you're looking at cash flow from operations. Operations annual, I mean, support ndalama zikwere kapena ndalama zisike. For example, increase in accounts payables. Increase in accounts payables abapa what we mean in the kuti angongole ano aja akachuluka. That period angongole ano achuluka. It means simunalipira. Ngati simunalipira, that means ndalama sikuchuluka business yanu. So ndalama ikuchuluka. Ikuchuluka imene that you are using for operations. So it increases your cash flow. Yabanga decrease ngati mukwalipira uchena ngongole anu, that means ndalama ikuchuluka, and for operation ikuchepa. So machipesa yani cash flow yanu. And depreciation, the expense here. Depreciation, you're talking about loss of value of an asset. So, for example, the guy would have depreciating the expense here. Because it's treated as expense, the expense here. That is why depreciation cash flow team pangira add back. Kuti pange increase uchenyani cash flow yatu. Increase in accounts receivables. Angongole kuti akupasani ndalama. Amapasani ndalama is you have a lot of cash in it. But angongole akamachuluka so vanhu takupasani ndalama. Which means ndalama si kukhala kumbejani for your operations. That is why, for example, the temperature will in Saudi ndalama. Because mostly if you look at the inventory increase in inventory. Stock yani kuchuluka. That means ndalama yani ikuchuluka business. Then there's a second part imene imatandiza so kwanga movement of cash for business imene ili cash flow from investment. So you're looking at what kind of investments have taken place in your business. Macro equipment it means so drains your cash in the business. And the last one, mainly cash from financing. Example, you are taking loans. I think the loan in the business, they will be cash in where loan cash in my shares dividend. Dividend, or my shareholder dividend yao. You sell ndama from your business. So you want to reduce the cash in the business. So these in simple, these are the three main sections here in financial reporting. Income statement, balance sheet, and statement.